I'm Kimberly Battle-Yonek. I'm a board member with FEI, which is Financial Aid International. We are actually maybe see our mission, but we are trying to advance leaders in our local area that are in CPAs, MBAs, people who have been in executive level, controllers, CFO. And we thought it would be a good idea to come talk to you all today. We have a mentoring effort. We have a mentoring committee. Kathy's on the mentoring committee. I'm on the mentoring committee. So we actually are hosting the event too with FEI. FEI does work with students. We usually work with undergraduates, and actually tonight we're going to give out scholarships for undergrads. Bergman is an undergrad here. I think that's probably the better, but we have typically worked with undergrads and passed out scholarships. We're going to do that tonight at Top Hall. And we wanted to try to reach the graduate students. So we decided to up our game and come see you all today. And I'm so happy that you all are here. Thanks all of you for coming. And thanks to our local panel. I'll introduce them and our main speaker. So our main speakers are Chrissy O Hara and Ben Taylor of softledger. And we have Matt Chang, and he's with High 2. He's been with Amazon with many years of great financial knowledge. With Josh Bergman, he's been with a robotics company and been at the CFO level, and is now working for another company. We have Margaret Shangraw, and she's with Catalyst Connections, and that's a local organization that deals with manufacturing and that deals with nonprofits and contracts.
Yeah, we're a nonprofit. We help small and medium-sized manufacturers in Pittsburgh.
And we also have Jen Dittmar, and she's with Powercast, and she's the controller there. So we got a really good group of people to talk to you. I'm an MBA, but I've also been a CFO and a controller. I was the director of finance for Shangraw. My favorite position though was when I was I set up a company that needed software. And I used to set up accounting systems, and we ended up starting an entrepreneurial school and doing technical assistance for the entrepreneurs. And my boss actually was my mentor, and he ended up being a senior professor. So that's how I got an interest in entrepreneurship. Seen a lot of business plans. I worked at Mellon. I used to do that for audit financials. So I thought the financial tools were essential for you to know. And there's many tools, and all of us, like I think of myself as a crafts person, and I build different tools based on where I am. And so all of us, have decided that, here's starting to work with a certain organization, and that, we should use it right. But FEI, is to advance the success of financial leaders in communities through knowledge sharing and unrivaled networking and meaningful allyship. So if you come to one of our meetings, you meet downtown. We meet downtown for Duquesne Club. We have gone through the tour of Duquesne Club, and that's where we found the history of movers and shakers doing deals at that club. So it's a very important place in our town, very historical. But we are there to network with the local business. People from tech, banking,
Higher
insurance,
education.
various financial organizations. And these are our speakers. And we offer we have a golf outing. I love our golf outing because we get to see each other and really talk to each other. But we also we are able to show appreciation to the people as sponsors. We are a nonprofit rather than, so we have lots of sponsors. And actually, softledger is one of our sponsors, our strategic partners. We offer CPE credits to the local talent. So we are trying to always increase their knowledge. Accounting doesn't change that much, but there's new technology, new things coming out, there's new pronouncements, new rules being developed. I'm saying that's what we said we can serve these communities. We actually just recently had Charlie Batch come to speak to us about his foundation. The best of that. That is Meredith, really, and that's been Meredith. I met Meredith because I met Craig. Craig was at one of our holiday parties, and that's a holiday party where we meet with other financial organizations. I would say there's like 300 people, 300 to 400 people show up, and I just happened to bump into him at the food table, and I said, "Oh, well, I want to work with the MBA and university ever, I'm wondering how I was going to get it to see you, and here you are." So, let's talk. And so we started talking, and he introduced me to Meredith, and Meredith came to our event, and she spoke, and she brought one of the entrepreneurs, Eugene and Sally. He talked about his business, and so from there we started a partnership. So we're very happy that you all had us here today, invited us out. These are some of the women. I think I see Megan and myself, and that's our. We have officers, so we have an eclectic group of people. And then we went to these are scholarship recipients. And CMU students can also, undergraduates can apply. And if you want more information about that, I can give you information about that. That's Charlie Batch, and that's our golf event. But we try to have fun. I mean, we're not, that's our holiday party. I like the Grinch being here, but it just, kind of loud up everyone. But we're a fun group of financial organizations. And we are sponsored by this group of companies. That's our goal, and platinum. So we are just happy to be here with you all, and we're going to turn it over to softledger at this point, and they will talk to you about their journey. So thanks for coming.
Thanks, Kim.
Oops, clicker.
Thanks everyone for coming out. I'll start off by introducing ourselves, and then, I'll introduce myself, and Chrissy will introduce herself, and then we'll get into it. I'm Ben Taylor. I'm the CEO and co-founder here at softledger. We provide accounting software for companies that have outgrown QuickBooks. I went to the University of Maryland, studied accounting there, then started my career at Ernst & Young in the Washington, D.C. area, and then was there for a few years, got my CPA there, and then went to Fannie Mae to do financial reporting, so working on 10Qs, 10Ks, other financial reports. So kind of come from this big company auditing and reporting background. And then a couple years later, when I started softledger, I was managing a few different areas in the accounting department for a public company, and it just took forever to get financial data because of this clunky general ledger we had in the middle of the process. And so I called up my longtime friend, Jeff Ostrega, who is a experienced software engineer, and with some convincing, we started building a general ledger on nights and weekends. That was about 11 years ago. Chrissy?
All right. Thank you. And I'm Chrissy O Hara. So I'm the CFO at softledger. I'm also a member of FEI and on the board with Kimberly. I just want to reiterate, it is a really great organization. Definitely keep us in mind as you advance through your career as an organization to join. A little bit about me. So I grew up here in Pittsburgh, and then I went to college in Washington, D.C. at George Washington. I got a undergrad and a master's in accounting there. Then I started my career at Ernst & Young in public audit before taking a role at Fannie Mae. So both me and Ben worked at UI together and Fannie Mae together before doing softledger together. We are also married, so there is, a lot of collaboration happening right here. So after Fannie Mae, we moved to Chicago, and I worked at a hedge fund called Citadel. While there, I got my MBA from Northwestern with a concentration in finance. Then when we got our first investor in California, we moved out there, and I worked at a real estate company for those 5 years. So I was the VP of finance. Then when we were heading back to Pittsburgh, I took a role as the head of finance at a company called Darwin Homes, which was a real estate startup. While there, we got bought by Pagaya, so I was kind of part of that deal. Pagaya is a financial services company, publicly traded. So after the acquisition, I stayed on for a little bit and worked there as well. And now I'm at softledger full time. So I've always been the CFO, but the first, 7 or 8 years, I was moonlighting, always having a second job. Since in a marriage, it's good to have one steady stream of income. But now we've been stabilized for a few years, and, we're in a good place financially. So it kind of gave me the opportunity to go full time at softledger. All right, let's get into what we're talking about today. So first, Ben will go through the background of our company, just give you a little bit more information about us and softledger. Next, we'll talk about getting off the ground. How do you start a business? I'll then go through metrics to track your growth and financial health. Then we'll pop back over to seed funding and some later stage growth. And finally, we'll talk about the 3 critical elements of every successful startup. There you go.
Okay. All right, thanks, Chrissy. Okay, so try to go through this timeline quickly from 2015 to today. So April 2015, I was in this accounting department for a public company. Took forever to get the financials. Had decided there had to be a better way, and so that's when Jeff and I got started on working on softledger. We did that for about 1.5 years before getting accepted into Mucker Lab, which is a startup accelerator in Santa Monica, California. So we packed up and moved across the country, showed up in our investor's office and figured, we'd made it. But of course, we realized at that point how hard it was to actually sell the product. And so we spent about 10 months selling before we got our first customer, which was a company that was going bankrupt and just needed a place to stick their data. But 1 customer became 2 customers, became 3, and then we kind of grew from there. In August of 2018, we had about 5 customers, didn't really have initial traction, I'd say. But we had identified this niche in there was no accounting software for companies using crypto in their operations. So we decided to focus on crypto, and we went through another startup accelerator, Acceleprise, in San Francisco to do that. That led to some investment. We got by the end of 2018, we had about 10 customers. And then we kind of just pounded the pavement and grew from there over the next couple of years. We were at about 4. We'd hired 2 employees by the time we raised our seed round in June of 2021, which that closed, and our first child was born within about a week of each other. So that was June 2021 was a pretty big month. Then a couple months later, we closed our largest ever deal, which was an embedded software deal, multi-million-dollar deal. Great validation, obviously great, came with some money that helped, support us over the coming years. That was a big milestone for us. And then in about a year after that, in August of 2022, we relocated to Pittsburgh. Originally from the East Coast, Jeff had actually moved to Baltimore earlier in the year. And I'm from the DC area, Chrissy's from here. We both love Pittsburgh, and it's a great place to grow a business. So we relocated ourselves and the company here. And then that turned out to be remarkably true, because in June of 2024, we finished our first fiscal year of being cash flow positive and profitable. And then fast forward to today, we serve over 2,000 organizations in more than 50 countries. and we're still growing efficiently and cash flow positive. Okay, so getting off the ground. So first step, how do you get started? You could just draw out what this thing is, what you think this thing is that you're building. That's what we did to start. I just drew on printer paper what I thought this software should look like. You could develop a business plan. You can, regardless of what you do, if you just start talking about it to people and explaining it, that's a really good way. Your idea is probably not quite right out of the gate, and the more you talk about it and build, you'll know and you'll iterate. You can do this on nights and weekends too. We did it for about 1.5 years before we went full time when we got our first investment. So a good early question is to ask, do you really need investment? You could bootstrap, meaning just fund the company through your own blood, sweat, and tears and bank account, and don't take any external investment. If you can do this is a great thing, because then you fully control the company, and if you have a cash flow generating sustainable business, that's pretty great. Services businesses lend themselves to this because you can sell your services and then fund, immediately get cash for that and fund your growth through that. Traditionally, software hasn't been like that. There's been more upfront development costs, but it's easier than ever to build and experiment with software. So there's been many examples of recent successful bootstrap companies. Whatever the case is, if you have a steady paying job and can afford to not quit, do that for as long as possible. You can get creative with it too. If you get started and need some extra cash, the founders of Airbnb famously sold cereal early to raise some extra money for the startup before they got going. I always love that story. If you decide that you want to build an investor funded business, there are plenty of options. First, incubators are very early stage programs that give you a little bit of cash, a little bit of advice, sometimes office space in exchange for equity in the company. These are typically pretty unstructured. Mucker really served as an incubator for us to figure out what we were doing and then to get our initial customers, which took more than a year. Accelerators are more structured. They're more like 3 or 4 months. They typically culminate in an investor demo day. Acceleprise was that for us. We had already had customers. We had just identified this focus on crypto accounting software. There being no crypto accounting software and serving that need. And so this really, that was right for us at that time. But a couple years prior, Mucker was better because we really, I don't think we would have been as successful going through Acceleprise at that time. Lastly, if you're lucky enough to have friends and family that will chip in, that's a great way to raise money early. And then angel investors too. Both of those, you could do that early or later at any time. And I'll discuss how that works a little bit later in the presentation. Next, Chrissy's going to go over some financial metrics that are key in the early days and as you grow.
Thank you. Okay, can't have a financial presentation without metrics, right? So rule number 1, don't run out of cash. Do not run out of cash. We cannot stress this enough. It sounds simple. It's hard. So make sure that, you are very in tune with where your cash flows are. Our original forecast file from back in the day, I always had this top line that just said months left until we run out of cash. It's like a calculated field. It's the first thing I saw when I opened it, highlighted it. It's very important. Do not run out of cash. So, make all the metrics and forecasts and every financial tool you need to make sure that this does not happen. Having a detailed cash forecast will allow you to make the right decisions for your company today. So obviously sometimes those are hard. Ben and Jeff had to make some hard decisions like downsizing, foregoing their own salary to conserve cash. But, you have to do what you have to do to keep your company afloat, right? And the one thing that every company needs is cash. Okay. Now that I've beaten you over the head with that, what other metrics should you be tracking? Well, there are a million of them. It's very dependent on your situation, right? What industry are you in? What do your external stakeholders care about? What do they focus on? What are your current company goals? You should really build most of your KPIs around, obviously there will be stuff externally you need to report, but internally you should base them around your current company goals. And those company goals will change over time, right? So want to emphasize that these are fluid, they are dynamic. Don't be afraid to delete KPIs as you're growing and as your company is changing. I'm sure other people in this room have had this experience where you start at a company, you go in, open their dashboard, there's 1,000 KPIs because no one's ever deleted any. And it becomes one of those things where like, well, if everything's important, then nothing's important. You don't know where to focus. So it's really important to just, constantly be refining and editing those KPIs to make sure that they're still valuable to you. Okay, so here are some ones for, our industry, SaaS, some metrics. I split these out into internal management and external reporting because those are two different cuts. These are all important to both sides, but they just have different priorities. Your external stakeholders are going to really care about growth. That's number one thing. Top line revenue, annual recurring revenue, things like CAGR, which stands for compound annual growth rate, metrics like that. Versus internal management, you need to keep the lights on, right? Like top line revenue, obviously important, but then what's your net income? After all the expenses come out, what's your bottom line? So things like that. Your internal management team will be looking at your past performance to see strengths, weaknesses, areas where you need to become more efficient to then build your financial plan for the future. Next, I'll give it back to Ben for some seed funding and later stage growth.
Thanks, Chrissy. Let's see. Okay. So just want to go through different investment types in the early stages. I found this to be pretty confusing when I got started. So attempting to summarize this without really losing anything. First, convertible notes and safes are instruments that are designed to enable your investors to contribute early while still capturing the upside of the first investment round where a price is established. These it's very tough to establish what a valuation is at the early stage, and so these kind of kick the can down the road, so to speak. Convertible notes are like they're debt that converts to equity when you have that first equity round. They're well understood by investors. They've been around for a long time, but they do involve debt, and so a lot of early stage companies don't like that. So Y Combinator came up with this other instrument called a SAFE, which stands for Simple Agreement for Future Equity. And those are a lot more popular with startups now. The next type of funding is an equity, sometimes called a priced round. And this is where you actually issue stock to your investors. It's where those convertible notes and safes convert into stock. These are a lot more expensive. They're harder to put together, a lot more work. And they typically require a full rewrite of your corporate documents. If you see a company raising a Series A, Series B, C, that refers to the series of preferred stock issued in that round. And so there are norms around what that means, what a company looks like at those stages, but know that that really just refers to the series of stock issued in each of those rounds. Last but not least, finding investors. How do you find them? For convertible notes and safes, those can be issued, those can be executed at any time on an ad hoc basis. We found investors through our network and advisors through the accelerators. And so if you look at professionals in your industry, founders in a similar industry, that's a good place to start. Equity rounds, on the other hand, that's a different story. It's best to find an investor that is actually in a position to lead your funding round. Is this coming through okay? Okay. You may find many investors that will contribute once you have a lead investor, but far fewer that will actually make the first move. And so I'd suggest kind of focusing on an investor that's in a position to actually lead your funding round at that point. We talked to more than 100 investors prior to getting the Naples Technology Ventures, who's the one who led our funding round, and we didn't even know them prior. They just were actively deploying capital, reached out at the right time, we hit it off, and 3 months after the initial intro email, we had the money in our account. Next, Chrissy's going to talk about some. Oh wait, actually. I think. Oh no, I got one more slide. And so when that happened, huge milestone for us. It was we were able to make some overdue investments in the company. We could hire engineers, spend more on sales and marketing. We could invest with a longer time horizon. Finally, it was a step change in how we were able to operate as a company. And frankly, I don't know if we'd be here right now without that funding round. But when we signed that agreement, we had given up some control of our company. We now had a board. We had an important stakeholder who had growth expectations. We have to provide updates to regularly, and he has to be involved in key decisions. Us simply growing the business in the way that we saw fit, not sufficient anymore. So it's a really big decision to take on an investor. It's not a changeable decision. Like they say, you can't fire investors. Okay, next, Chrissy's going to go over some later stage funding options.
Great, thank you. Okay, so here's some institutional funding. These are all, bank financing, so you have to be a little bit bigger to get these. Some more for growth stage or mature companies. The first one, traditional bank loan, we all know what that is. To get one as a small business, you have to be in operations for 2 to 3 years, have some sort of track record with customers and revenue, and usually provide a personal guarantee. The second one, revenue-based financing, similar to traditional loan, except it offers more flexibility in when your payments are, so you can time them with when you're recognizing revenue and collecting cash from customers. Because of that flexibility, it does have a slightly higher interest expense, but it is popular when people are first getting started and their cash flows are kind of lumpy. The third one, lines of credit. This is my favorite one, but definitely for more, mature companies, because you do need some sort of like current assets on your balance sheet to collateralize the line. But how they work is you might get like a $10 million line of credit, and then you're not paying any interest until you actually draw down on the line. So you might have like a small project you need funds for, something like that, and draw down $1 million. You're only paying interest on that $1 million for the time you have it outstanding, and then you can just kind of pay it back, whatever. So it's a good like safety net. Last is venture debt, which is very specific to startups because it only is available if you've done an equity round. So what happens is a bank that caters to startups will offer to give you between 20 and 40% of the amount of money that you raised in the round. So let's say you just raised $10 million. They might offer you $3 million in venture debt. And the interest expense is relatively lower because it comes with an equity component. There's a common stock warrant attached to it that if there's a liquidating event or an IPO, something like that, then the bank will owe shares in your company. So, it's about, it's small, but not nothing. They're usually around like 0.25%. So, it is, they get that upside, and that's why the interest expense is a little bit more favorable. Okay, mature stage funding. What most people talk about with startups, the exit. Right. So first, let's talk about no exit. It is possible to not have an IPO or get acquired. You can just start a company, grow it, make it profitable. Your heirs inherit it and you have generational wealth. Great. So don't ever forget about that option. Second, IPO. Obviously, this is the one that everyone knows. It's kind of the gold star, right, for startups. You have to be pretty large. You got to still be really fast growing, and all the market conditions have to align, which, that last part is not really in your control. So IPOs are very hard to come by. So, if the stars align, great, but you shouldn't really count on that one. Much more common is an acquisition or a JV or a merger. Now, these can be either strategic or private equity, non-strategic. A non-strategic acquisition would look more like kind of predictable. They're actually buying you to be a portfolio company. So they're going to look at your financial statements and do a pretty predictable valuation. Whereas a strategic partner will be looking at your product, your IP. So that one, they might not care if you're as big and all that kind of stuff. And so one last thing, on the acquisition, these, even though they're more common than IPOs, they still usually don't go through, right? Like over the years, we've had, 12 to 15 offers to buy our company, ranging from not so serious to maybe serious, but every single one of them has fallen through. So it can really fall apart at any stage in the process. And you just kind of have to be prepared for that, take it in stride and move forward. As we always say, it's like a good acquisition deal always goes through. So if it doesn't go through, it wasn't meant to be. It wouldn't have been a good partnership for you. And you just got to kind of keep moving. Okay. Lastly, the 3 critical elements of every successful startup. Identified a problem, created a solution, and passionate founders. So I feel like the first one is probably the hardest one, and where people get most tripped up is identified a problem. Being out in California around Silicon Valley and a lot of entrepreneurs, We saw a lot of programs and softwares that were really neat. They were very cool, but they didn't really solve a problem in the marketplace or fill a void in the marketplace. And with that, you run the risk of people liking your product, but not actually wanting to pay for your product. And so if you're not creating enough value by solving a problem for your consumers, they're not going to pay for it. And obviously that's not a way to run a profitable company. Number 2, created a solution. Once you identify the problem, this might seem a little bit easier. And I think where people get tripped up in the solution part is as you grow, you might get further and further away from that original problem. Especially when you're building something like software, you're going to continuously have these like forks in the road where you have to go this way or this way, this way or this way. And you make all these decisions. And once you're deep in the weeds, you might be getting further and further away from what that original problem was that you identified in number 1. So as you're creating your solution and building your product, you want to always be able to take a step back, get a higher level view, and make sure that you're still solving that problem you first identified so that you're still creating value for consumers. Last but not least, passionate founders. If you're not your company's number 1 fan, there's an issue, right? You got to be really passionate about what you're doing. You have to be passionate about the solution. You have to be passionate about the problem. It's obviously it's a tough road sometimes. So you want to be fully in it and fully committed to it. And so, I'll end the presentation by saying if anyone in this room is passionate about solving the problem of parking here at CMU prior to the next time I have to come, that would be really, really great. Thank you. And with that, hand it back to Kimberly.
Thank you. That was fantastic.
Great. Thanks.
I just want to see, who do we have in here? What stages are you all at as far as business development? You want to speak? You want to speak?
I was actually curious if your exit strategy has changed over time, and how you decided when an investor was like, good, if you can't fire him, how did you evaluate if he was a good choice for your partnership?
That's a great question.
That's a great question. There's definitely no playbook for that. But I guess you have to be prepared you have to know what's important, prepared to walk away if it's not the right thing. I think we're guilty of this too. Is we got early hung up on maybe valuation or some other things that are very early. It's like 5% of nothing is nothing. So if it doesn't happen, then who cares? And so I think you sometimes can get stuck in this like, okay, I'm like putting together what the stack of all the percentages lead up to, and so like there's certain things that don't matter so much, but then you got to know that in the early stage ones are less. You have to worry about a little bit less, like the equity round. That's where some of the more important kind of restrictions come in that you really can't change.
I can speak to the acquisition. And your other question was acquisition strategy change?
Yeah.
Or exit strategy change over time. Yeah, because that one's funny to me because we always talk about how when we first started it, both being CPAs and stuff, we were like, we're going to beat Microsoft. Like, we're going to be just, shoving this in Bill Gates' face and stuff like that. And it's like, and we're going to become this huge company. And then we were kind of like, this is really hard. And it's really hard, especially with something like accounting software. Accountants are conservative by nature. Coming in and being like, hey, do you want to switch from Oracle to this thing being run by Ben and Jeff out of our apartment in Santa Monica? It was like, no. So then we were kind of like, well, maybe, if we were to, not be in this current state, more like a strategic type partnership. So like the only real serious acquisition we ever had was like one where we would still work there. I mean, because also you have to think about your personal own goals. So, this is like our baby now. Like we don't know what we do without softledger at this point. We want to still see it grow and, we believe in it so much. So strategic partner acquisition is really the only thing we've ever entertained. So there was one that was, like a large publicly traded software company that we would have had a lot of synergies with, still worked there, stuff. That was really the only one that we entertained. And to be honest, that one fell through. We had no idea why, because that's also just part of the game. It was like, and it feels like crushing. But again, if it's not meant to be, it's not meant to be. Those things, it wouldn't have been a good partnership then if it doesn't go through, right? So that's kind of where we are at now.
I would like to hear from the panel. Does anyone want to address that question? Do you remember the question? The question was,
no, what specific?
The question was, how do you determine what investor you want to go with? You don't always want to go with an investor because they want to go with you. So any thoughts?
So I would say it depends on your risk tolerance and maybe what you're looking for. So, a more financial minded investor, where they're just, PE back, VC back, they're going to be looking for how fast can I get my money back and how much can I get back? So they may not understand your business as much. They just see there's a unique opportunity. But just know that in now those board meetings that you might be having, or those monthly reports, they're going to be scrutinizing everything. They're going to want to know, okay, why aren't you growing as fast as you said you were going to be? Why aren't you as profitable? How much runway do you have left? So they're definitely going to, I would say, take a more skeptical stance. Whereas a strategic investor is going to be more interested in how do you fit into their macroeconomic plans? How do you fit into maybe their portfolio and the business that they're doing elsewhere? Not that they're still not going to be concerned about your growth and your profitability and your pathway to success. But they're going to understand your business model maybe a little bit more than a purely financial investor would. So those are the things you want to think about rather than just, it's money. How much of the equity am I giving up and how are they going to impact the way I run the business?
Mary Margaret, do you have anything?
No, just conversely, with level of board involvement, everybody, likes an involved board. You don't necessarily particularly want to be involved with somebody who isn't very interested and invested in you. I've been around boards that haven't been very engaged, and they should be pushing you. So you want to feel like they're on your side and they care. Money's great. It's nice when people are asking a lot of questions, but those questions are good. So you really want somebody who is involved, just money aside, from a personal standpoint, they want to be pushing and driving and, wanting to be a part of it, not just uninterested.
That's a good point.
Anyone else have any other questions?
Hi, thanks for your talk. This was quite assuring, also not reassuring. I'm in a course called AIBS here at CGMA. It's an interesting course where you have AI as a co-founder, and we have gone through a lot. We have a prototype set up. We're on a B2B C space, and some of the questions kind of start becoming different because on a consumer or on a business side, you can have a really specific product you're building for a specific client. So you have all those financials and everything is much more easier. I feel like it's much easier to get funding. But what have you guys seen on the B2C side or B2B C side? It's more difficult. At least that's what we have seen. Investors like the idea, we have to do alpha work. They do like it, but then there's always that where's the traction? All we care about is traction.
Anyone on the panel want to answer that? Or you want to fill it?
Okay. Yeah. I guess I'll start off by saying we're being B2B. I'm really happy that I don't have to deal with the B2C problem because I don't know. I've seen at Mucker, especially our first the incubator we went through. There were a lot of B2C startups that it is everything, the network, that getting going. And so I think, with B2B, we're charging a lot more per customer. We can do a lot more. We handhold during it. And I think that's somewhat true with B2C as well, but that's a lot tougher to do efficiently.
Yeah.
Okay. Yeah. Sorry. Don't have
So
much.
no help.
It's a long-winded way of saying it. I don't know.
Jen, you want to answer that?
I know.
in the travel space.
Yeah. Anyone?
Yeah.
What are you? Are you doing something technical with the travel space?
Yes, it's a on trip AI travel assistant, which
Oh, that
acts like
sounds
a guide. There's more on the planning side of things, but there's nothing on your trip. So you want to keep plans, but the changes.
That's good.
You don't really care about the museum. You want to do
No, I just thinking on a personal end. That sounds like
Yeah.
because I can think about how many times I've been on trips and I've had to like change things. You know,
Yeah.
I had an RV trip out west we took, and we had to change a lot of
How far along
That's-
are you? How far along are you? You have a business plan?
we have a business plan. We have a demo day actually coming up in April. It's a huge cohort, but like everyone else is doing B2B, and you have all these exit strategies and like things like that. But like in B2C, it's like becomes difficult, especially if you're on a immigration visa. So you can't like really go on a make a business, get it back, and things like that. So
Anyone else have any questions?
Does it have a cool name?
it's got Navio for now.
Okay.
What other businesses are represented here? Or business startups? Is anyone else working on a business startup at this point? Do you have a concept? Okay.
Currently, I am in like a customer discovery process of building a company.
I'm sorry, what kind of?
Automotive.
An automotive company, okay.
I have a question for you guys though, because you mentioned about the slide where not to run out of money. What tools or software do you guys use to keep track of your finances?
Just Excel, to be honest.
Literally just whispered Excel. Like,
Yeah, it's funny. The simpler the better. People always, poo-poo Excel, which I'm not going to get on my podium about, but because I love Excel. But it is for something like that simple. Excel is just honestly the easiest thing. Don't overcomplicate the wheel there. Just looking at your bank accounts, having your forecast, updating it in Excel in a manual thing that's easy to change is really the best tool in the early days.
And we even use that so we're a nonprofit and we're mostly federally funded, and there's a lot of federal uncertainty in the current political environment, and we get grants, so we have to forecast out. We have a liquidity spreadsheet that feeds all of our bank information. On one tab, it summarizes, what we think we're going to pay out. So we do ratios on that. So we can think of what's our runway, do we have a 6-month coverage, so we're looking at that all the time. Because, before I left here, my CFO, he previously worked in a lot of startups, and he said, I'm sure the first thing they're going to talk about is don't run out of cash. Really? And that's,
It is, yeah.
We've been around for 30 years and that's one of our biggest things, especially, being federally funded, is to monitor it. And Excel is just
It's just easiest sometimes, especially when it's a manual thing or you need to make one quick change here and there. So I think especially as you're growing a company, it's so much stuff changes. Or your company, so much stuff changes. It's
just easier just to.
We have a Corp ERP system, but we still use Excel.
Oh,
okay. And with all the LLMs, you can just tell it to build a lot of stuff for you too.
Yeah, that's true.
Now, when you grow the therapy is very good.
Well, I probably most of the students here at work or here probably know that, but it's more more. No. I don't use it so much for work. I use it more for optimization. So we have a portfolio of projects and things similar to what you were saying, a bunch of different projects. So you're looking at optimization just for different things where you can run out of money, what the mix is.
And Jen has been working with a new product for analysis too.
Yeah.
Data Rail.
Yeah, so Data Rails is a financial planning and analysis software, and they are Excel based. So when you get to that point where you feel like you need a little bit more than regular Excel can give you, Data Rails will connect with your ERP system or QuickBooks, things like that, and it'll pull in your information in real time And then you can automate your monthly reporting, very important, I'd say, as soon as possible, to start doing like a monthly financial package and get in the habit of seeing where you are, and absolutely 100% with the cash flow forecasting. We're 20 years old and we're still trying not to run out of cash too. I hope one day we won't have that word.
I just bought a software a week ago that's Excel based to plug into my ERP because I couldn't stand and it's Excel and I could feed it all in. I just started building reports.
Data works with various ERP systems.
Oh yes, it works with a lot of different ERPs.
Talking about one.
Connect it to ERP is like a ledger account, QuickBooks or an accounting system. A bigger accounting system usually is what an ERP would be. We're smaller. We just use QuickBooks. That's what a lot of startups do. It's pretty user friendly, even if you're not an accountant. But Data Rails, not only will it pull in that information for you from your ERP system, so you're not having to manually, pull reports and take things over and all that, but each month you can tell it, okay, I'm ready to do, my February report now, and you just roll it forward and it updates all your dates and pulls in the new information. I've been doing that for my financial package and for my cash flow. So that keeps things really up to date. That's not something you're going to want to do in the very beginning, but it's really nice as you get on down the road a little. They also have a lot of great KPIs, and just you can do a lot of different modeling, play with. If I do, focus on this project, what might my outcome look like, things like that.
And it probably would work with softledger as well.
Yep.
Yeah, same concept.
Yeah.
I want to speak for you.
Oh yeah.
One of the reasons I wanted you all to hear from softledger
Same thing.
because I work with QuickBooks and I work with a QuickBooks dealer and I've seen QuickBooks online, and I feel like we need an alternative.
Right here.
They offer. Yeah. So, and I came to Pittsburgh thinking I'm going to solve this problem. Like I took accounting and I took IT, and I felt like if everyone could just see the value of computers and systems. And when I came through, we had Peachtree, and then Sage stayed around, and it made BusinessWorks and a couple other packages. And then I eventually moved up to QuickBooks. But I'm saying we've gone through various stages, so there's something new out there that we should look at as well. Anyone have any questions?
Again.
Yeah, I apologize if you already clarified this, but is it like standalone system softledger, or is it like partnered with other ERPs for a company?
No,
Standalone.
Yeah, so we compete with like NetSuite, Sage, our two biggest competitors, really, if people are deciding between the systems.
Yep. And then also quick, are you guys doing annual SaaS agreements, or you longer contracts?
They're almost all annual. We have a few that are longer term. But
Yeah.
Generally the embedded ones.
The embedded ones are multi-year. Yeah. So like our longest one is 15 years, but it was like, huge undertaking embedded into their back end, stuff like that. It's another software company. But yeah, almost all of ours are prepay annual terms.
Do you have any other questions for us? All right, well, we thank you. I think it's 1:30 already. When the time is so fast. Thank you all for coming.
Thanks so much.
It was a pleasure to get to talk with you all. And hopefully maybe we'll see you again.
Yeah. Great.
Thanks for listening.
Thanks.
Thank you. Thanks to all the panel guests, and thanks to softledger.
Yeah, great. Thanks.
I appreciate everyone's time. Have a great day.
Thanks.
They want to go somewhere.
Yeah, like, what is, who are you? Like, I know.